In 1997, South Dakota quietly removed the rule that had limited how long a trust could hold wealth. No announcement, no national debate. A technical amendment buried in state statute, and the wealthiest families in America started moving money the same year. The estate tax has existed in the United States in some form since 1916. The stated purpose was straightforward: prevent the permanent concentration of inherited wealth, ensure each generation face the same starting conditions, keep aristocracy from calcifying inside a republic. By 1976, Congress added the generation skipping transfer tax, specifically designed to close the workaround where grandparents transferred wealth directly to grandchildren, skipping a taxable estate. The architecture of the law looked solid. It was not. A dynasty trust is not a loophole in the colloquial sense. It is a deliberate legal structure that holds assets, equities, real estate, private company stakes, artwork, inside a trust vehicle that never terminates. Beneficiaries receive distributions, they use the wealth, but the legal entity holding that wealth never passes through probate, never triggers an estate tax event, and never resets. The Rockefeller family office has operated variations of this structure since the 1930s. The Pritzker family, owners of Hyatt hotels, restructured generational holdings through irrevocable trusts that removed assets from taxable estates before their children could walk. The Walton family has held Walmart shares in trust structures that, according to filings analyzed by the Center on Budget and Policy Priorities in 2013, sheltered an estimated $11.9 billion from estate taxation across a single decade. The mechanism requires a jurisdiction willing to host it. For most of the 20th century, the rule against perpetuities, a common law doctrine dating to the Duke of Norfolk's case in 1682, prevented trusts from lasting longer than a life in being plus 21 years. That put a hard ceiling on dynastic accumulation. Then, in 1986, South Dakota became the first state to abolish that rule entirely for trusts administered within its borders. Delaware followed in 1995, Nevada in 1999, Alaska shortly after. Today, a trust established in Sioux Falls, South Dakota can legally exist for 365 years. The assets inside it will compound, untouched by estate tax, across 12 to 15 generations of a single family. Here is the part that did not add up when researchers at the Federal Reserve began examining wealth concentration data in the 2010s. The top 1%'s share of national wealth had not merely grown, it had grown faster after 1997 than any economic model tied to income growth alone could explain. Wages, market returns, even favorable tax rates did not account for the acceleration. What the models had not fully weighted was the compounding effect of assets that never faced a transfer tax event. Money that never gets taxed at transfer does not just grow linearly. Inside a dynasty trust invested in a diversified portfolio returning 7% annually, $100 million becomes $1.3 billion in 40 years, without a single dollar changing legal ownership, and without triggering a single taxable event. The estate tax, structurally, had not been reduced. It had been made optional for those who could afford a trust attorney in Sioux Falls and a family office to administer the paperwork. In 1983, South Dakota abolished the rule against perpetuities. That single legislative decision, signed quietly by Governor William Janklow, removed the legal ceiling that had forced inherited wealth back into the taxable economy every generation for 300 years. Nevada followed in 1995, Delaware in 1995, Alaska in 1997. One by one, states rewrote trust law not to serve their citizens, but to attract the administration fees of dynastic capital. Today, South Dakota alone holds an estimated $367 billion in trust assets, a number that has tripled since 2010. The wealth does not live there. The families do not live there. Only the paperwork does. Here is the mechanism in full. A family office establishes a dynasty trust in Sioux Falls. The founding generation transfers assets into the trust using the lifetime gift tax exemption, which stood at $12.82 million per individual in 2023. Inside the trust, those assets compound across decades, across generations, across centuries, without triggering estate tax at each generational transfer. The generation skipping transfer tax, created by Congress in 1986 specifically to close this loophole, contains an exemption that mirrors the estate tax exemption exactly. Attorneys at firms including Bessemer Trust and Northern Trust documented this architecture openly in client memos as early as 1997, describing the GST exemption as a permanent shelter when allocated correctly at inception. The Pritzker family, whose fortune traces to the Hyatt hotel chain and exceeds $34 billion today, restructured holdings through irrevocable trusts across the 1990s. A 2002 Senate Finance Committee investigation documented how the family used layered trust structures to shift hundreds of millions beyond the reach of transfer taxes. The investigation produced a report. The report produced no legislation. The Internal Revenue Service identified the problem with its own tools before most of Congress understood what South Dakota had done. A 1997 IRS Technical Advice Memorandum flagged dynasty trust structures as aggressive tax avoidance requiring closer scrutiny. The memorandum was classified. It did not become public for 6 years. When it did surface, through a Freedom of Information Act request filed by tax law professor Lawrence Wagoner at the University of Michigan, the relevant regulatory window had already closed. The Treasury Department reviewed dynasty trust structures formally in 2000 and declined to issue restricting regulations, citing, in its own language, the need for further study. That study was never completed. 3 separate Government Accountability Office reports between 2006 and 2019 flagged the generation skipping exemption as a mechanism concentrating inherited wealth at a scale inconsistent with the tax code's stated policy goals. All 3 were received. None triggered a floor vote. The human cost does not appear in the trust documents. It appears in the property tax rolls of states that have watched their revenue bases hollow out, while billionaire trusts incorporate across their borders. It appears in the balance sheets of public pension funds in Illinois, where the pension system carried a $211 billion unfunded liability as of 2023, while the Pritzker family's trust-held assets remained legally exterior to state estate taxation. It appears in the Walmart associates who retired with hourly wages and no equity stake, while the Walton family's dynasty trust structure, documented in estate planning literature by attorney Daniel Worthington in 2018, preserved an estimated $8.7 billion from a single generation of transfer taxes. The mechanism is not illegal. That is precisely why it endures. Illegality can be prosecuted. Perfect legality requires no defense. The point of no return arrived not with a collapse, but with a census figure. In 2022, the Federal Reserve's distributional financial accounts data recorded that the top 1% held $30.6 trillion in net wealth. The bottom 50% held $3.7 trillion. Embedded inside those Federal Reserve tables, without annotation, without asterisk, is the compounding output of 40 years of dynasty trust accumulation. The trusts are working exactly as designed. In South Dakota, trust legislation has been amended 17 times since 1983, each amendment extending protections further, closing gaps that might allow taxation to reach inward. The last amendment passed in 2021. It received no national press coverage. The architecture is complete. The clock on some of those trusts will not expire until the year 2348. When Congress passed the Tax Reform Act of 1986, it created the generation skipping transfer tax specifically to stop dynastic wealth from jumping across generations untouched. It worked for about 4 years. In 1990, South Dakota quietly repealed its rule against perpetuities, the centuries-old legal doctrine that prevented trusts from lasting forever. Nevada followed. then Alaska, then Delaware. A quiet legislative arms race among states competing for trust business, each offering longer durations, stronger asset protection, lower disclosure requirements. No federal intervention came. No congressional hearing produced a remedy. The Internal Revenue Service acknowledged the structures, studied them, and ultimately concluded they were legal. Law professors named it the race to the bottom. The architects of South Dakota's trust industry named it economic development. Both were right. The families who moved first captured the most. The Pritzker family's trust architecture, partially exposed during the 2002 Illinois gubernatorial confirmation hearings for Rod Blagojevich's appointment of Penny Pritzker to a state board, revealed a layered system of offshore entities and domestic perpetual trusts that had shielded hundreds of millions across multiple generations. No prosecution followed. No clawback occurred. The Walton family, through a series of grantor-retained annuity trusts and generation-skipping structures, documented in estate planning literature and cited repeatedly in academic tax scholarship, transferred the bulk of Walmart's founding fortune across generations at a fraction of the statutory estate tax rate. The Congressional Budget Office estimated in 2021 that dynasty trusts and related mechanisms cost the federal treasury between $40 and $60 billion annually in foregone estate tax revenue. The families involved broke no law. That is the precise point. The system is not a relic. As of today, South Dakota holds an estimated $700 billion in trust assets, a figure that has more than doubled since 2010. The state employs a trust industry that lobbies its own legislature to extend durations and tighten privacy protections further. The current South Dakota Dynasty Trust can now run for 365 years. When those trusts mature, the United States that exists in 2389 will inherit wealth structures assembled in boardrooms that no longer exist, serving heirs who have not yet been born, governed by documents signed before their great-grandparents were conceived. And every dollar inside will have traveled those 3.5 centuries without once passing through an estate tax return. Tell us in the comments, does this look like a loophole to you or a feature? And if you want to keep seeing the systems most people never think to question, subscribe to 0 Hour Capital. Every week we expose another system they hoped you would never understand.